my name is Charlie Luke and I'm the manager of the Murray Income Trust. As a brief introduction, Murray Income is an investment trust which is over 100 years old with over £1 billion of assets, which has the investment objective of generating a high income, growing that income and delivering capital growth through a diversified portfolio of large and mid-cap companies, principally UK listed ones, but we do also invest around 20% of the portfolio in overseas listed companies. So how do we achieve income for the fund? Well, nearly all of the income is generated from the companies in the portfolio paying a dividend, which after deducting costs such as management fees and other expenses can be paid out to shareholders as income in the form of a dividend. We pay 4 dividends per year and have increased the annual amount of income paid per share every year for the last 50 years, which provides us with our AIC dividend hero status and is one of the longest track records in the market. This has been helped by the structure of investment trusts that allows us to squirrel away income or reserves in the good years to pay out in the less good years. The dividend yield on the shares is attractive, being just under 4.5%. We have a very simple thesis that for a company in the portfolio to grow its dividends, it needs to grow its earnings, and we think good quality companies are best placed to do that over the long term. Therefore, the portfolio is focused on a diversified selection of good quality companies, and by good quality, I mean companies with sustainable competitive advantages, and that might be intellectual property or brands, scale, or network effects. Companies led by experienced management teams with sound financial characteristics and robust growth opportunities. We're not interested in companies with really high dividend yields, as that's generally a warning sign that the dividend is likely to be cut. Instead, we're keen to invest in businesses with attractive dividends that can grow those dividends as they grow earnings over the long term. We're trying to marry together the benefits of quality on the one hand and income on the other, with good quality companies providing earnings resilience and sustainability, less volatility, and having a greater margin of safety, or in other words, companies that are more likely to deliver on their dividend aspirations. And that resilience was key to the income generation of the portfolio over the COVID pandemic. Then the benefit of income is where the dividend provides a valuation underpin and encourages management to think about the long term. And in the middle of the Venn diagram, the outcome of the focus on both quality and income should be a portfolio capable of generating long-term capital growth while providing an attractive and resilient income stream. I mentioned at the beginning that we have a diversified portfolio, normally of around 50 holdings. We're keen not to put all of our eggs in one basket, so we have thoughtful diversification with, as a rule of thumb, not more than 5% of the capital or 5% of the income coming from any one particular company, and the portfolio is also diversified across different sectors. It's also worth mentioning that turnover is modest, as we have a patient buy and hold approach, seeking to allow the fundamentals to win through over time, which is helpful in terms of reducing frictional expenses and trading costs. And because we can invest up to 20% of the portfolio in overseas listed companies, that allows us to invest in companies and industries that would be difficult for UK-only investors to gain exposure to. We have investments in some of the world's best quality businesses that help to diversify the portfolio and provide long-term income growth, such as L'Oreal in cosmetics, LVMH for luxury goods, Kone for elevators, MasterCard for payments, and Microsoft for technology. To provide some more examples of holdings within the portfolio, we own companies that have exposure to attractive long-term trends that should be a tailwind to earnings and hence dividends. So, for example, looking at 4 of these compelling long-term trends, AstraZeneca and Convatec benefit from aging populations. SSE and Rotork can ride on the coattails of the energy transition. Increasing wealth of middle classes in emerging markets should help Unilever and Inchcape. While finally, the dynamic of digital transformation should benefit holdings such as Sage, Experian, and Relex. So to summarise and explain why the trust might be attractive to someone already in retirement, well, The income attractions of the trust are the generous dividend yield of just under 4.5% on the shares, with the portfolio invested in great quality companies able to grow their earnings and hence their dividends over time, which should allow the trust to continue its very long track record of dividend growth. In addition, the dividend is paid quarterly, and given the investment trust structure, we have our rainy day revenue reserves of over a half of the full year dividend that can be used to top up the dividend if necessary. The shares are currently trading at a generous discount to their net asset value, so it's possible to buy the assets for around 10% less than their worth, which itself is attractive given the broad undervaluation of UK companies compared in particular to their US counterparts. So hopefully that explains the income attractions of the fund, and thank you very much for your time today.